On July 6th of this year, Strategy, the company formerly known as MicroStrategy, disclosed that it had sold 3,588 Bitcoin for approximately $216 million. It is the largest single Bitcoin sale in the company's history. It happened below the company's own average cost basis, and it happened 1 month after the same company sold Bitcoin for the first time since 2022, breaking a promise its own chairman had repeated publicly for years. This video is not about whether Michael Saylor is a hypocrite, and it is not about mocking a video he posted days later showing himself as an armored knight defeating a bear. This video is about something far more useful to you personally. Understanding exactly why a company holding more Bitcoin than almost anyone else on Earth was forced to sell some of it, what that reveals about the difference between owning Bitcoin directly and owning exposure to Bitcoin through a leveraged company, and why that distinction should change how you think about your own portfolio, regardless of whether you have ever bought a single share of MSTR. Every figure in this video comes directly from Strategy's own SEC filings, verified reporting from multiple outlets, and public statements from the company's own executives. None of it is speculation about what happens next, and none of it is a price prediction. It is an explanation of a mechanism, and by the end of this video, you will understand that mechanism better than most people currently commenting on it. Okay guys, before we move on, I need your help on this. As you've noticed, we changed the video format. We moved from the avatar-only format to this whiteboard style, and honestly, this new format takes far more time and far more work than what we used to produce. Every illustration you're seeing is hand-built block by block, and that is simply not sustainable if it's not actually working for you. So here's what I need. Drop a comment right now with your city, the time it is for you as you're watching this, and what the weather looks like where you are. That's it. 3 things. If this comment shows up, it tells me you're actually engaged with this new format, not just letting the video play in the background. And that's the exact signal I need before deciding whether to keep producing videos like this one going forward. Don't forget to hit that like button and subscribe. This really helps us. This channel runs on direct feedback now, not on an algorithm deciding what's worth making. So if the whiteboard style is landing for you, this is the moment to prove it. City, time, weather, right below. Let's get into it. Strip away the narrative and look only at what Strategy's own regulatory filing says. Between June 29th and July 5th, the company sold 3,588 Bitcoin in 2 separate tranches. The first tranche, 1,363 Bitcoin, sold at an average price of $59,256. The second tranche, 2,225 Bitcoin, sold at an average price of $60,773. Blended across both tranches, the average sale price works out to roughly $60,000 per coin. The proceeds were not reinvested into more Bitcoin, and they were not used for operations. According to the company's own disclosure, the money-funded quarterly dividend payments across 4 separate preferred stock series, known by their tickers STRF, STRE, STRK, and STRD, plus the full monthly dividend on a 5th instrument, STRC. Together, these 5 securities form what Strategy calls its digital credit business, and each one carries its own fixed payout structure, with STRF, the senior tier, paying a fixed 10% annual dividend on a $100 stated amount. This was not the company's first sale this year, and understanding the sequence matters. In February of last year, Saylor posted publicly that Strategy would never sell its Bitcoin. Up until that point, the company had sold Bitcoin exactly once, 704 coins, in December of 2022, purely to offset capital gains for tax purposes. Then, between May 26th and May 31st of this year, the company sold 32 Bitcoin, a small amount but symbolically significant since it broke that specific public pledge for the first time. The July sale, that is the subject of this video, is roughly 100 times larger than that first 32 coin sale. Strategy's own chairman described the shift directly. The company is transitioning from a strict buy and hold accumulation model to what he called active balance sheet monetization. That is a significant, publicly acknowledged change in strategy, not a rumor or an inference drawn from a filing. It is the company's own words. Following the sale, Strategy's total holdings stood at 843,775 Bitcoin, with a cash reserve of $2,550 million, up from $1,400 million the week before. The sale accomplished exactly what it was designed to accomplish. It replenished the dollar reserve needed to keep the dividend payments flowing on schedule. It is worth understanding how Saylor himself has framed this shift publicly, because his own language is more revealing than any outside commentary could be. Speaking at Goldman Sachs' Digital Asset Conference in London the same month, Saylor highlighted Bitcoin's growing role as collateral for what he called digital credit, and specifically noted that using Bitcoin as collateral had financed the purchase of 175,000 Bitcoin throughout market downturns. In that same appearance, he described plans to use Bitcoin as a resource for funding shareholder dividends going forward, effectively previewing in public the exact mechanism this video is now walking through after the fact. The company has also disclosed the existence of a formal Bitcoin monetization program, authorizing sales of up to $1,250 million in Bitcoin, which, at a price of $63,500 per coin, works out to approximately 20,000 Bitcoin, or about 2% of the company's current holdings. The stated intention behind spreading any future sales gradually across multiple exchanges and over time is to reduce price impact and avoid the kind of slippage a single, large, concentrated sale would otherwise create. None of this reads like an emergency measure invented on the fly to cover an unexpected shortfall. It reads like a formally authorized, board-approved program with a specific dollar ceiling, designed and disclosed well in advance of any specific sale. That distinction matters because it separates this story from a genuine liquidity crisis and places it much closer to a deliberate, if uncomfortable, shift in how the company intends to fund its ongoing obligations going forward. None of these facts, taken alone, prove that Strategy's underlying Bitcoin thesis has failed, and Bernstein analysts specifically pushed back on the idea that the company faces forced selling, noting that Strategy still purchased approximately 175,000 Bitcoin for roughly $14 billion so far this year, an accumulation pace far larger than the recent sale. A company selling a small percentage of its holdings to meet a specific disclosed obligation is a meaningfully different situation than a company being forced to liquidate its core position, and conflating the two overstates what actually happened here. Here's the detail that changes this story from an interesting footnote into something genuinely important to understand. Strategy's average acquisition price across its entire Bitcoin treasury sits at approximately $75,476 per coin. The July sale executed at a blended average of roughly $60,000 per coin. In plain terms, the company sold Bitcoin for less than it paid for it, on average, across its entire holding. This detail gets sharper when you look at the timing of Strategy's own buying and selling in the weeks immediately surrounding this event. Between June 1st and June 22nd, Strategy purchased 3,657 Bitcoin for $236 million at an average buy price of $64,534. 1 week later, the company began selling 3,588 Bitcoin at an average price roughly $4,500 lower than that recent purchase price. A crypto trader using the handle Kaleo calculated the net effect of this sequence directly. Because the company bought high and then sold low within the same short window, the implied average cost of the additional Bitcoin the company actually kept, after netting the buys against the sells, worked out to over $289,000 per coin. The net result of all this activity was a position increase of just 69 Bitcoin, despite the company having deployed roughly $20 million in additional net capital across both transactions. This sequence did not happen because Strategy's treasury team is incompetent. It happened because the company operates on two separate, sometimes conflicting timelines simultaneously: a long-term accumulation thesis driving the buy decisions, and a short-term cash obligation, the preferred dividend schedule, driving the sell decisions, with neither timeline able to pause and wait for the other to produce a more favorable price. It is worth sitting with how unusual this is for a company that has spent years building a reputation specifically around not selling. Strategy's entire public identity, cultivated deliberately over multiple years of conference appearances, social media posts, and shareholder letters, has centered on the idea that Bitcoin, once acquired, simply never leaves the balance sheet. A dividend obligation forcing a sale below the price the company itself had paid just weeks earlier is not a subtle contradiction of that identity. It is a direct, numerically documented one, sitting in the company's own regulatory filing for anyone willing to read it. This is the central mechanism this entire video is built around, and it is worth stating as plainly as possible. A structure that must generate cash on a fixed schedule, regardless of what the underlying asset is doing on that specific week, will eventually be forced to transact at whatever price the market happens to offer on that exact date, even if that price is objectively unfavorable relative to the company's own recent activity. That is not a flaw unique to Strategy. It is a structural feature of any entity carrying fixed cash obligations against a volatile asset. It is worth being precise about the accounting context here as well, since headlines around this period also cited an $8.3 billion loss tied to digital assets in the second quarter. That figure reflects the accounting treatment required under current fair value rules for how public companies report Bitcoin holdings on their books. It captures unrealized paper losses from Bitcoin's price decline over the quarter, not a cash outflow, and it is a completely separate figure from the $216 million in actual cash raised through the coin sale covered in this section. Selling below cost basis on a specific tranche does not necessarily represent bad long-term capital allocation. if the company's overall average cost basis across its entire multi-year accumulation history remains meaningfully below current prices, which it does, since $75,476 still reflects an average built up over several years of buying at both much lower and much higher prices than today's level. Judging a single sale in isolation, without the full multi-year buying context, risks making this look worse than the company's overall position actually is. If the phrase implied average cost of over $289,000 per coin made you want to grab a calculator and check the math yourself, that instinct, wanting to verify a number instead of just repeating a headline, is exactly the habit the Bitcoin Holders Bible is built to reinforce. It walks through how to read a company's own SEC filings for exactly this kind of detail, how to separate accounting losses from real cash losses, and how to tell the difference between a company under genuine balance sheet stress and one simply meeting a disclosed, planned obligation. Normally, this ebook is $97, but the code DIAMOND50 at checkout brings it down to $47 with the same full money-back guarantee I've mentioned before. If it doesn't leave you able to read this kind of filing yourself, you get every dollar back, no questions asked. And remember, this channel doesn't run on ad revenue anymore, so every person who picks this up is helping keep videos like this one being made. The link is in the description and pinned in the comments. I see the diamond. Let's get into why this structure exists in the first place. None of what happened in this story makes sense without understanding one specific concept. MNAV, short for market net asset value. The calculation is simple. Take the company's total market capitalization and divide it by the net value of its Bitcoin holdings after subtracting outstanding debt. A result above 1 means the stock trades at a premium to the Bitcoin sitting on its balance sheet. A result below 1 means the stock trades at a discount, meaning the market values the company at less than the Bitcoin it holds. For most of the past several years, MSTR has traded at a meaningful premium to its NAV, at times reaching a multiple of 2.6 to 2.8 times the value of its underlying Bitcoin. That premium is not an accident or a market inefficiency waiting to be arbitraged away, because unlike a spot Bitcoin ETF, MSTR shares cannot be redeemed for the underlying coins. The premium exists purely because of sentiment and because the company uses that premium as fuel for a specific or repeatable strategy. Issuing new shares or convertible debt while the premium is elevated, then using the proceeds to buy more Bitcoin than the capital raised would have bought at the plain market price. This is the mechanism Saylor's team refers to as BTC yield, and it is run at roughly 5.6% year-to-date through mid-April of this year, according to the company's own reporting. When the MNAV premium sits comfortably above 1, every dollar raised through issuance buys more than $1 of Bitcoin exposure for existing shareholders, a genuine and real form of value creation, as long as the premium holds. The mechanism runs in reverse just as cleanly, and this is the part almost never explained clearly to retail investors treating MSTR as a simple Bitcoin proxy. When the premium falls toward 1 or breaks below it, issuing new shares stops adding value and starts diluting existing shareholders instead. Since the company would then be selling stock for less than the Bitcoin backing it is actually worth. MSTR briefly touched 0.97 times its MNAV in November of last year, the first time it had traded below parity since January of 2024, and more recently the premium compressed to approximately 1.14 times, down substantially from its late 2024 peak. This compression is precisely why MSTR behaves as what analysts describe as a leveraged proxy for Bitcoin, rather than a direct substitute for owning it. During January and February of this year, Bitcoin fell approximately 36%, while MSTR fell approximately 44% over the same stretch with premium compression, not Bitcoin's price movement alone, driving roughly half of that additional drawdown. The leverage cuts in both directions with equal force. It amplified gains on the way up, and it is now amplifying losses on the way down. Underneath all of this sits a capital structure most casual observers never look at directly. Strategy carries approximately $8.2 billion in convertible notes, plus multiple series of preferred stock, together representing roughly $18.5 billion in claims that sit ahead of common shareholders in the event of any liquidation. Annual preferred dividends alone approach $1 billion, while the company's original software business used $21,600,000 in cash during the most recent full year. Nowhere near enough to service that obligation on its own. It helps to see the actual dividend rates involved, because the range is wide and the obligations are not identical across instruments. The preferred series, trading under the tickers STRK, STRF, STRD, and STRC, carry stated dividend rates ranging from roughly 8 to 11.5% annually, fixed obligations that do not shrink simply because Bitcoin's price has fallen. Grayscale's own head of research estimated the company's total annual dividend load across all 5 instruments at approximately $1,500 million. A fixed cash bill that exists regardless of whether Bitcoin is trading at $60,000 or $120,000. This is the part of the story most casual commentary skips entirely, because it requires sitting with an uncomfortable structural fact rather than a simple villain. None of the preferred securities are actually backed by Strategy's Bitcoin directly. Each one holds only a general claim on the company's residual assets, meaning preferred holders are owed cash, not coins, and the company's own management has to decide, quarter after quarter, exactly where that cash comes from. When the software business cannot generate it and market conditions make issuing new equity at an attractive price difficult, selling Bitcoin becomes the remaining lever left to pull. A leveraged structure is not automatically a doomed one, and Strategy's convertible notes are due over a period of years, not all at once, giving the company considerable time to manage its obligations through multiple market cycles rather than facing a single immediate cliff. Companies with far more aggressive leverage ratios than Strategy's have survived multi-year drawdowns before, and treating leverage itself as proof of an inevitable collapse ignores the fact that leverage has, for most of Strategy's history since 2020, worked exactly as designed and dramatically increased Bitcoin per share for long-term holders of the stock. Strategy did not invent the corporate Bitcoin treasury model, but it did popularize it aggressively enough that an entire sector now exists in its shadow, and that sector's scale is larger than most casual observers realize. As of earlier this year, roughly 200 publicly listed companies collectively held nearly 1.28 million Bitcoin, worth approximately $100 billion at the time, according to a mid-year report from crypto asset manager 21 Shares. That figure represents a real fall short of expectations. 21 Shares had entered this year targeting a combined $250 billion valuation across the sector by year-end, a target that now depends entirely on a meaningful Bitcoin price recovery to close the gap. The report's own language is worth repeating directly. Most major players in this sector are now trading below the value of the coins they actually hold, and a subset of smaller players are being forced to sell Bitcoin simply to keep their operations afloat. Forbes reporting from earlier this year captured the same dynamic from a different angle. Smaller treasury companies have traded between 10 and 75% below the value of the Bitcoin sitting on their own balance sheets, meaning the market is pricing these companies as though their Bitcoin holdings are worth meaningfully less than their actual verifiable market value. That is not a subtle discount. A company trading 75% below its own Bitcoin holdings is being valued by the market as though a large fraction of that Bitcoin does not exist or cannot ever be realized. The risk officer at Strive, one of the newer entrants into this exact sector, offered a blunt description of how varied this category has become. These companies are grouped under one label, but they all do genuinely different things, with some simply holding Bitcoin as a passive reserve and others actively layering debt and leverage on top of their holdings to amplify exposure. Swan Bitcoin's own CEO put the more aggressive philosophy even more directly. Without leverage, a company isn't really playing this specific game at all. That philosophy works exactly as intended during a rally and works viciously against a company during an extended drawdown, and this is not merely theoretical. Bloomberg's own reporting on this sector used the phrase market contagion directly, describing crypto-hoarding treasury companies that helped turbocharge last year's rally, as now sitting at risk of sparking broader instability as selling pressure mounts across the category. Bitcoin's correlation with equities has climbed from roughly 0.15 in 2021 to roughly 0.7 today, a structural shift analysts partly attribute to exactly this kind of leveraged corporate exposure now sitting between Bitcoin's price and the traditional stock market. Strategy, for all its own struggles covered earlier in this video, remains the largest and, by most measures, the most conservatively financed of these treasury companies, with the longest track record and the deepest capital markets access of any name in the category. If the largest, most established player in this sector is still being forced into balance sheet monetization to meet its obligations, the pressure facing smaller, less established treasury companies with weaker capital structures deserves serious attention rather than dismissal. There's a genuine historical precedent worth naming for how quickly sentiment toward this exact kind of structure can shift, and it comes from a different, earlier Bitcoin vehicle. Grayscale's Bitcoin Trust, once the dominant way for institutional investors to gain Bitcoin exposure before spot ETFs existed, traded at a persistent, sometimes severe discount to its own underlying Bitcoin holdings for an extended stretch, driven by structural redemption limits rather than by the value of the coins it actually held. Investors who assumed that Trust's share price would always track its Bitcoin holdings closely learned, over a period of real pain, that a wrapper around an asset can trade meaningfully apart from the asset itself for longer than most participants expect. The treasury company sector now sits in a structurally different position than Grayscale's Trust did, since these are operating companies with active capital markets access rather than a closed-end fund with fixed redemption mechanics. But the underlying lesson transfers directly. Any wrapper standing between an investor and the raw asset introduces its own separate set of dynamics, and those dynamics can dominate the investor's actual return for extended periods, regardless of what the underlying asset itself is doing. It is equally true that this sector remains, in aggregate, a genuine source of long-term demand pulling Bitcoin out of active circulation and into long-term corporate custody, a dynamic covered in earlier videos on this channel. A wave of forced selling among the weakest, most poorly capitalized treasury companies is a real, current risk worth monitoring. But it is a meaningfully different claim than asserting that the entire corporate treasury model is fundamentally broken, when the majority of Bitcoin held by this sector still sits with better capitalized companies showing no signs of forced liquidation. If you are holding MSTR or any other Bitcoin treasury company stock alongside your own direct Bitcoin position, and you have never actually calculated that company's MNAV or checked its debt maturity schedule for yourself, that gap in verification is precisely what the Bitcoin holder's Bible exists to close. It walks through exactly how to calculate MNAV for any treasury company, how to read a convertible note maturity schedule, and how to tell the difference between leveraged exposure that is working as designed and leveraged exposure that is quietly becoming a liability. The regular price is $97, and code DIAMOND50 brings it down to $47. Same guarantee as always. If it doesn't leave you able to evaluate this for yourself, you get every dollar back, no questions asked. This channel runs on people picking this up, not on ad revenue, so every purchase is genuinely part of how videos like this keep getting made. Link in the description, pinned in the comments. I see the diamond. Now let's get to the question that actually matters for you personally. It is worth stepping back from the mechanics for a moment and simply looking at what has happened to MSTR as an investment, since the stock's own performance tells a story that neither pure hype nor pure panic captures accurately. MSTR shares closed at $100.77 on July 2nd of this year, up 21.1% over the preceding week following the announcement of the company's digital credit capital framework. And yet the stock remained down 73.7% over the trailing 12 months. That combination, a sharp weekly rally sitting inside a brutal year-long decline, is precisely what a 5 times leveraged proxy on a volatile underlying asset is supposed to produce in both directions. Strategy's own stated approach, publicly described by its management, is to issue equity and convertible debt whenever the MNAV premium sits above 1, using the proceeds to buy more Bitcoin and increase Bitcoin per share for existing holders, a metric the company itself tracks and reports as BTC yield. The company's broader ambition, sometimes referred to as its 21-21 plan, describes a multi-year roadmap to raise approximately $42 billion over 3 years, specifically to expand its Bitcoin reserves further. That is an enormous amount of future capital raising sitting on top of an already highly leveraged balance sheet, and it means the mechanisms covered throughout this video, MNAV premium, share issuance, convertible debt, are not a one-time event tied to this single dividend payment. They are the ongoing, ordinary operating model of the entire company, for as long as that plan remains in effect. Seen through that lens, this specific $216 million sale is a small, almost routine data point inside a much larger, multi-year financial engineering program, not an isolated crisis. That reframing does not make the underlying mechanics any less real or any less worth understanding. It simply places this one event correctly within a much longer, ongoing story rather than treating it as a sudden, unprecedented rupture. A $42 billion, multi-year capital raising ambition, layered on top of a company already carrying $18.5 billion in senior claims, is a genuinely aggressive scale of future leverage, and it depends heavily on capital markets remaining open and reasonably favorable to the company for years at a stretch. A prolonged period of depressed Bitcoin prices, combined with a persistently compressed or negative MNAV premium, could meaningfully impair the company's ability to execute that roadmap as originally envisioned, forcing either a slower pace of accumulation or continued reliance on asset sales rather than fresh issuance. Here's the question this entire video has been building toward, and it deserves a direct, honest answer rather than a dodge in either direction. If you hold Bitcoin directly in your own wallet or through a spot ETF with no debt, no preferred dividend obligation, and no fixed cash schedule to service, does anything covered in this video actually change your own thesis for holding it? The honest answer is no, and understanding precisely why is the entire point of walking through Strategy's specific situation in this much detail. Every mechanism covered in this video, the MNAV premium, the convertible note obligations, the preferred dividend schedule, the forced timing mismatch between buying and selling, exists because Strategy chose to layer corporate leverage on top of a Bitcoin position. Remove the leverage, And every single one of those specific pressures disappears entirely because none of them are properties of Bitcoin itself. They are properties of the corporate structure built around it. This is precisely the distinction lost in most of the commentary currently circulating about this story. Bitcoin itself did not develop a dividend obligation. Bitcoin itself did not issue convertible notes with a maturity date. Bitcoin itself did not need to be sold below its own recent purchase price to meet a payment schedule set by a corporate finance team years earlier. A direct holder of Bitcoin, with no leverage attached, was never exposed to any of the specific pressures that forced this particular sale, regardless of how loudly the holder's own feed might be discussing it right now. This does not mean the story is irrelevant to a direct holder, and dismissing it entirely would be its own kind of mistake. It means the correct lesson is narrower and more useful than either extreme currently being argued online. The lesson is not that Bitcoin's thesis is broken because a leveraged company was forced to sell some of its position. The lesson is that leverage, in any form, on top of any asset, introduces a set of risks and forced timing pressures that the underlying asset itself does not carry, and conflating a leveraged proxy's struggles with the underlying asset's own health is a category error every serious holder should be able to catch. There's a second, subtler lesson worth drawing out as well, one this channel has touched on in a previous video about the mistakes that make Bitcoin holders lose money. Watching a company you don't even own stock in sell part of its position, and feeling your own conviction shaken by it anyway, is a version of hurting, reacting to someone else's decision as though it carries information about your own situation, when in fact that decision was driven entirely by a corporate obligation that has nothing to do with your own holding thesis at all. This distinction between direct ownership and leveraged corporate exposure does not mean direct Bitcoin ownership carries no risk of its own. A direct holder still faces genuine price volatility, genuine custody risk if self-custody is handled poorly, and genuine regulatory uncertainty that has nothing to do with any company's balance sheet. The point of this section is not that direct ownership is risk-free. It is that the specific risks covered throughout this video, tied to leverage, dividends, and forced timing, are not among the risks a direct, unleveraged holder actually carries. If you do hold, or are considering holding, exposure to Bitcoin through a treasury company rather than directly, this story provides a genuinely useful checklist, built from the specific mechanisms covered in this video, rather than from a general sense of caution. The first check is calculating the company's current MNOV for yourself, using its most recent Bitcoin holdings, its most recent share count, and its outstanding debt, rather than relying on a headline describing the company as simply cheap or expensive. A premium above 1 carries a different risk profile than a discount below 1, and knowing which side of that line a specific company currently sits on changes what any further share issuance actually means for you as a shareholder. The second check is identifying whether the company carries any fixed cash obligations, preferred dividends, convertible note interest, or debt maturities, and critically, whether its non-Bitcoin business generates anywhere close to enough cash to service those obligations without touching its Bitcoin treasury. Strategy's own software business generating a small fraction of its required dividend payments is exactly the gap that produced the sale covered throughout this entire video. The third check is looking at the timing symmetry, or lack of it, between a company's stated long-term accumulation strategy and its short-term cash needs. A company with no fixed near-term obligations can simply wait out an unfavorable price environment indefinitely. A company with dividends due on a specific date cannot wait for anything. It must transact at whatever price the market offers on that date, a structural disadvantage no amount of long-term conviction can offset. The fourth check, and the one most relevant to the broader sector covered earlier in this video, is comparing a specific company's current stock price against its own Bitcoin holdings value, checking specifically whether that company trades at a meaningful discount, which several smaller treasury names currently do by between 10 and 75%. A steep discount can represent either a genuine buying opportunity or a market correctly pricing in real balance sheet stress, and the only way to tell the difference is checking that specific company's debt schedule and cash flow directly, rather than assuming the discount is automatically an inefficiency. None of these 4 checks require a finance degree, and all 4 are built directly from publicly available filings. The exact same category of document this entire video was built from. The habit worth taking away from this story is not a verdict on any single company. It is the muscle of checking a corporate structure's actual mechanics before treating its stock price as a simple, interchangeable proxy for the asset sitting on its balance sheet. There is a 5th check worth adding specifically because of the historical GBTC parallel covered earlier in this video, checking how any given wrapper's structure allows or restricts the flow of capital in and out. A spot Bitcoin ETF allows continuous creation and redemption of shares against real Bitcoin, keeping its price tightly tethered to Bitcoin's actual market value. A closed-end trust with limited redemption mechanics, or a highly leveraged operating company with fixed debt and dividend obligations does not offer that same tight tether. And the size of that gap is exactly what has produced both persistent premiums and persistent discounts throughout this asset's history. Put simply, the more a specific wrapper resembles a straightforward pass-through vehicle, the more closely its price should track Bitcoin's own price over time. The more a wrapper resembles a leveraged operating company with its own separate obligations, the more that wrapper's price becomes a function of its own capital structure, its own sentiment, and its own specific stress points, sometimes for extended periods, regardless of what Bitcoin itself is doing on any given day. This is exactly why the Bitcoin Holder's Bible exists. It walks through the full framework covered in this video, calculating M/NAV, reading a convertible note schedule, checking dividend coverage against actual operating cash flow, and comparing a treasury company's stock price against its real Bitcoin holdings. So you can evaluate any company in this sector for yourself instead of reacting to a headline or a viral thread. The regular price is $97, and code Diamond50 brings it down to $47. And just like I've said throughout this video, that comes with a full money-back guarantee. If it doesn't leave you able to evaluate this kind of store yourself going forward, I refund you, no questions asked. Remember, this channel doesn't run on ad revenue anymore. Every person who picks this up isn't just buying a book, they're one of the people actually keeping this channel able to keep making videos like this one. I see the diamond, and the link is in the description and pinned in the comments below. Strategy sold 3,588 Bitcoin for approximately $216 million, its largest sale ever, below its own average cost basis, to fund dividend obligations across 5 preferred stock series that its own software business cannot come close to covering on its own. The sequence of buying high in June and selling low in July produced an implied cost on the coins ultimately retained of over $289,000 each, a direct consequence of running a long-term accumulation strategy against a short-term, fixed cash obligation. This is possible because of MONAVE, the mechanism by which MSTR trades at a premium or discount to its underlying Bitcoin holdings, a premium the company has used for years to accrete Bitcoin per share, and a premium that now sits meaningfully compressed from its late 2024 peak, turning the same mechanism that built the position into a source of pressure during the current drawdown. This is not unique to Strategy. Roughly 200 publicly listed companies now collectively hold nearly 1.28 million Bitcoin, and a meaningful subset of the smaller, less capitalized names among them are already trading at steep discounts to their own holdings and facing real forced selling pressure. None of this changes the thesis for a direct, unleveraged Bitcoin holder because none of the specific mechanisms covered in this video, dividend schedules, convertible note maturities, MNAV compression, exist as properties of Bitcoin itself. They exist as properties of the corporate leverage layered on top of it, and confusing a leveraged company's struggles with the underlying asset's health is exactly the kind of category error this channel exists to help you avoid. MSTR itself, meanwhile, closed the week of the framework announcement up 21.1%, while still sitting 73.7% below where it traded a year earlier, a combination that captures the leveraged proxy dynamic covered in this video more clearly than any single number could on its own. And this entire dynamic sits inside a much larger, multi-year plan to raise roughly $42 billion for further accumulation, meaning the mechanisms covered in this video are not a one-time event. They are the company's ongoing operating model for years to come. Nothing in this video should be read as a dismissal of genuine concerns about the corporate Bitcoin treasury sector. Bloomberg's own reporting has used the specific phrase market contagion to describe the risk this sector poses if selling pressure among weaker treasury companies accelerates and Bitcoin's rising correlation with equities, partly attributed to this exact dynamic, is a real structural change worth taking seriously rather than waving away. It is also true that even Strategy, the most established and best capitalized name in this entire sector, is now engaged in what its own chairman calls active balance sheet monetization rather than pure accumulation. A meaningful shift from the public commitments the company made for years. Nothing in this video should be read as certainty that this shift stops here, or that further sales from Strategy or from smaller, more fragile names across the sector will not continue if Bitcoin's price remains depressed for an extended period. The GBTC parallel covered earlier in this video also cuts both ways honestly. That trust discount eventually closed, and closed dramatically when spot ETFs launched and gave investors a genuine, redeemable alternative, rewarding patient holders who understood the structural cause of the discount rather than panicking during it. But that resolution took years, required a specific regulatory and market development nobody could have guaranteed in advance, and does not promise that every current mispricing across today's treasury company sector resolves on any particular timeline, or resolves favorably at all for every name currently trading at a discount. Michael Saylor sold $216 million of Bitcoin below cost basis to pay dividends on preferred stock, and days later posted a cinematic video about never losing to the bears. Both of those things are true at the same time, and neither one, by itself, tells you anything meaningful about whether you should hold Bitcoin directly. What this story actually tells you, if you take the time to read the filings instead of the headlines, is a precise mechanical lesson about the difference between an asset and a leveraged claim on that asset. Bitcoin did not develop an obligation to anyone. A corporate structure built on top of it did, and that structure is now paying the price for the leverage it chose to carry. Understanding that distinction is worth more than any opinion about Saylor's video in either direction. It is also worth being fair to the man at the center of this story, whatever your view of his marketing choices. Saylor did not hide this sale, did not bury it in a footnote, and posted about it himself on the record the same day it was disclosed. Whatever critique is fair to make about the timing of a bear fighting video days later, it should sit alongside the fact that the underlying transaction itself was disclosed transparently through the proper regulatory channel exactly as required. Drop a comment below telling me whether you hold Bitcoin directly, through a treasury company stock like MSTR or both, and whether this video changed how you think about the difference. The most thoughtful comments get pinned, because the goal of this channel has always been clarity, not picking a side in an online argument. If this video helped you separate a leveraged company's problems from Bitcoin's own thesis, share it with the one holder you know who's currently panicking over a headline instead of a filing. Philosophical close. Every cycle produces a moment like this one, where a large, visible name in this space stumbles publicly, and the entire market briefly treats that stumble as a referendum on the asset itself. It happened with exchanges collapsing in prior cycles. It happened with individual miners going bankrupt, and it is happening again now with a leveraged treasury company meeting its own preferred dividend schedule. The habit that separates a holder who survives these moments from one who gets shaken loose by them is not loyalty to any single company, any single chairman, or any single cinematic video about bears. It is the discipline of asking, every single time, whether the thing that just happened is actually a property of Bitcoin, or a property of the leverage, debt, or obligation some separate entity chose to build on top of it. That question, asked consistently, is worth more than any single video, including this one. Saylor will keep posting. The price of MSTR will keep swinging harder than Bitcoin itself in both directions. And some future headline about some future treasury company's forced sale will eventually replace this one as the story everyone is arguing about. The specific names will change. The mechanism underneath them, leverage meeting a fixed obligation against a volatile asset, will not. Recognizing that mechanism the next time it appears under a different company's name is the actual lasting return on the 8,000 words you just watched. See you in the next one.